Pick any major broad market index you want. Almost all of them are at or knocking at the door of all-time highs. The picture isn't any rosier when we look at some common valuation metrics either. For example, the Shiller PE, which tries to measure the price P to the earnings E, is at elevated levels compared to historic data. We're also seeing a high level of retail traders in the market, although this may even just be a structural shift since the pandemic, and this has led to some more violent moves, especially in the meme stocks such as the now infamous GameStop. The market also seems to be dominated by a handful of mega cap companies, and at concentration levels we've not seen since the 1960s, even far outstripping the dot-com bubble. So this has led to some commentators calling the market a bubble and that we should get out. But how do we know if we're in a bubble, and what should we do about it if we are? So I think the first thing we need to understand is that all-time highs doesn't necessarily mean we're in a bubble. If companies can continue to grow their margins, revenues, profits, balance sheets, etc., then that can lead to further and further expansion of the market as a whole. So if we look at this chart, all the times when the S&P 500, which is an index which tracks 500 of the largest companies in the US, the times when the market hits an all-time high are shown with a little green dot, and you'll notice there's a lot of green dots on the chart. In fact, the S&P 500 has spent 44% of its trading days at or within 5% of the all-time highs. And part of that might just be driven by the breakneck growth projections we're seeing, which at the moment are far in excess of historical average rates. And because the market by its very nature is forward-looking, after all, we're buying a share of future cash flows in companies when we buy shares in them. So if we're projecting high growth, then we'd expect to pay a premium for that growth. Now, if you're on my newsletter, you might have seen this story before, but let me introduce you to Bob. So it's 1970, he's 22 years old. For his retirement savings plan, he plans to save £2,000 per year in the 1970s, £4,000 per year in the 1980s, £6,000 per year in the 1990s, and so on and so forth, saving just a little bit more each decade. So in 1970, he's just kicked off his career, and in 1970, 71 and 72, he saves £2,000 per year and decides to take the plunge, and he invests it all in the stock market and buys a product that tracks the S&P 500 at the end of 1972. Unfortunately for Bob, it was a bad time to get involved, and over 1973, the stock market drops almost 50%. But Bob is diligent, he keeps saving every year as he plans, but he's a little bit shaken up after that first experience of investing. And so every time he's saving, he's just saving in cash at the moment, but he never sells out of anything that he's bought once he's invested in the stock market. And because he's not invested in the stock market, Bob misses out on this rally shown here on the chart in the screen. But he finally plucks up enough courage to get his foot back into the market, and it's 1987 by this point. He's got 15 years of savings, and he plonks them back into the market. But unfortunately for Bob, the market starts dropping the day after he invests, and overall the market falls about 30%. Bob gets spooked again for investing, but he continues to put money away each and every month, even if it's not invested into the stock market. Now fast forward to 1999. The internet is arriving. It looks like it's going to be this new revolutionary technology that's going to just drive markets higher forever. Since Bob's last attempts to invest in the stock market, he saved a further £68,000. And by now, it's December 1999, he decides it's time to take the plunge with his next round of investing. Unfortunately for Bob, this turns out to be another spectacularly bad investment decision. The market drops around 50% over the next 2 years as the dot-com bubble bursts. But Bob knows he still has a retirement fund, so he continues saving regularly, but once again, he's put off investing in the stock market. By now, October 2007 is coming around, and Bob is approaching 60 years old, and he's saved another £64,000 since his last foray into the markets. And since the dot-com bubble burst, he's seen a return to the good times, markets are looking very strong, and so Bob decides once again it's time to take the plunge. Unfortunately for Bob, it's another really bad market timing decision. He invested £64,000, and then the global financial crisis hits, and Bob experiences another 50% haircut on the money that he's just invested, which is pretty bad timing, Bob. So by the time 2013 comes around, Bob is 65 years old, he's planning to retire, and after his bad investing experience over his career, when he's literally picked the top of every local high, he isn't too confident that he's going to have very much money left. Now over that working career, he saved £184,000 and invested at every worst possible moment. But in itself, he's been very diligent and he's stuck to his original plan, saving the amounts that he expected to save every single decade. Now fortunately for Bob, he did one very important thing. Bob never sold out of the market. Despite investing at terrible times, he kept the course, only letting the market spook him after each crash, which gave him just long enough to save up some more money and invest again. So how did Bob do? Well, on his 65th birthday in 2013, he decides to check his pension balance, and Bob finds out that he's actually a millionaire. Bob has £1.1 million invested, despite picking the worst possible times to invest and getting spooked after each crash, missing out on the next part of the rally. Now that's pretty good for the world's worst market timer, don't you think? But if Bob hadn't been spooked after each crash, and instead of saving up a pot of money to invest until he had confidence, he'd simply drip-fed that money each month and each year into the markets, he would have done a lot better than his £1.1 million. Bob would have finished with £2.3 million, even better. Now this story does tell us that even investing at poor times historically has been a great move over the long term. And if the future looks anything like the past, we'll certainly have some big market crashes to coming. After all, Bob took 30 to 50% haircuts multiple times in his investing journey. But the best companies will continue to make money, will continue to innovate and find new products. And so staying the course and investing will help you if you have a long time horizon. Now, if you want more market news and investing talk, you can join my newsletter via the links in the description, and you can join me on my own journey to a £1 million investment portfolio. Now, hopefully I'll have much better timing than Bob did. I'll share my portfolio updates and interesting stories that you might like that are just like this in the newsletter. So thanks very much for watching, and I'll see you in the next video.